I guess I'm asking for your vote. So, buy Liberty Stars. It's a John Malone spinoff. It's announced, or its news is broken, that it's hired investment bankers. The capitalization is about 10.5 times free cash flow, 9.5 times EBITDA. It's got 100 million shares outstanding or so at $31 a share. So it's $3.1 billion in size. It's reasonable enough. It's pretty big. You can buy it with ease. There's $1.1 billion of net debt, so the total enterprise value is $4.2 billion. Trailing EBITDA is about $460 million, so that's how we get to our numbers, and free cash flow is about $300 million. So let's just see if we can get the slide to go. That's us. And this is what STARZ actually is. You've probably seen it on your TV set. It's sort of like HBO or Showtime. They produce a series of serials like Outlander, Black Sails, Spartacus is a popular one. And they also produce, display first-run feature films. Disney and Sony have contracts with STARZ. So anything those two studios produce, STARZ will air and then pay those studios in turn. STARZ then has contracts with guys like Comcast and DirecTV to charge a fee per household. The cable company keeps a hold of some of that money and passes the rest back to STARZ. So there's not a lot of CapEx involved in the business, and it's not very working capital intensive. They do, however, spend on original content. So now that we have a sense of what the capitalization is, and you can already kind of guess that net debt to EBITDA is about 2.5 times, so it's reasonably levered. They've bought back almost 17% of the company since the spinoff in 2013. So just a quick history lesson on the business. It started in 91. In 94, the Encore and STARZ networks came into being. So first Encore in 91, then STARZ in 94, and flash forward to today, it was spun off in 13 and now is up for sale. It's what you'd call a mature, fully distributed cable network in the sense that there are 34 million homes that get Encore and 22 million homes that get STARZ. The risk reward here we think is about 40% up and 14% down. We think that because if the thing is taken out and it's on, let's say, 9.5 times EBITDA, really these deals trade at 12 times. The bank that was hired to do this deal is the same bank that represented Liberty Media in its failed acquisition of Time Warner Cable earlier this year, and is the same bank that acquired Virgin Media on behalf of Liberty International. So it's very much John Malone's bank, and John Malone controls 46% of the voting stock. It's game time for STARZ. They're done. They're not quite sold yet, but they should be soon. When news of this first broke, the stock traded up a bit. Now it's backed off because of the oil shock we had. And so we're very built up on it. I think that the industrial logic of the deal is pretty clean. Comcast is acquiring Time Warner Cable. That's a $45 billion transaction. And AT&T is acquiring DTV. That's another $45 billion media transaction. That's a total of $90 billion of consolidation on the part of two very big customers for STARZ. So they need to find somebody else to merge with so that they can have negotiating power in their carriage agreements. So I guess to recap, I'd say it's a stable business. They've got long-term contracts with the movie studios, long-term contracts with the cable companies, although that will change in time, or I should say they'll renew in time. Leverage is reasonable. The risk reward we think is compelling. If there's no deal and we think it goes back to, let's say, 26 or 27 bucks, that's maybe 14% downside. But in an environment where M&A has literally doubled by volume in the past year, and where there are tremendous transactions that have happened in this space where this company operates, we think it's a compelling story. I have a little bit of time left, so I've said what I wanted to say. So I'll yield the balance of my time, and thank you very much for having me. I'm Mike Winston from Sutton View, and I'm asking for your vote.